All right, good morning, ladies and gentlemen, and welcome to the ECB Rate Prep with your host, Tony, the head financial analyst at FinancialJuice, and also running MacroAce with you guys here. So let's get into it. We've got about less than half an hour till we get the ECB rate decision at quarter past the hour. So let's get right into it. So with the ECB interest rate decision, what is the deposit rate? It represents the first interest rate paid by the ECB to banks having a deposit at their central bank, and they provide the deposit facility where banks can place excess reserves and earn an interest rate that is usually 100 basis points or percent below the main refinancing rate, which establishes the floor on interest rates, since no bank will lend money out less than what it can earn at the deposit facility. Then, where is the economy at the moment? Inflation at 2.9% compared to the prior of 2.4%. Core CPI is at 3.4% compared to 3.6%. So already inflation having, although closer to the 2% goal, still experiencing a little bit of turbulence with that there. Eurozone manufacturing PMI was at 46.6 compared to 44.4. Services was at 48.4 compared to 48.8. Consumer confidence at minus 16.1 compared to minus 15. And German IFO business climate at 85.2 compared to 86.6. ZOO economic sentiment was at 15.2 compared to 12.8. And CPI in Germany was at 3.2% compared to 3.8%. And the HICP, the year on year, was at 3.8% compared to 2.3%. Then the previous ECB meeting data and comments that we had that came through from them. So they said that they see growth picking up from an average of 0.6% for 2023 to 0.8% for 2024 and to 1.5% for both 2025 and 2026. They also added that inflation has dropped in recent months and is likely to pick up again temporarily in the near term, and they see 2023 inflation at 5.4% compared to the prior forecast of 5.6%. According to the latest Eurosystem staff projections for the euro area, inflation is expected to decline gradually over the course of the next year before approaching the ECB's 2% target. And that comment hasn't changed since that comment has more or less remained the same if we're looking back to going back to June 2023. They said something similar, or more or less the same thing, that they don't expect inflation to get to the 2% target until 2025. They also said at this meeting that the rate level must be maintained for a sufficiently long time, and the economy is expected to recover because of rising real incomes. So wages are key at this ECB meeting. And for any other comments that come through post the meeting and the comments that have come before the ECB rate decision, wages are quite key for the ECB in regards to keeping an eye on price pressures. And we'll go into that in a little bit more detail with the ECB members and what they've said and the expectations from banks and traders. Then Financial Times with their portfolio, with the ECB portfolio summary of what the ECB is going to do. So they said that the central bank would reduce the reinvestment of maturing securities in the 1.7 trillion euro portfolio it started buying in response to the COVID pandemic from the second half of next year, instead of continuing until the end of 2024. So they're looking to offset or remove basically whatever they've added during the COVID pandemic time by the end of by the second half of this year rather than the end of this year. So that is seen as quite hawkish, or that's seen as a hawkish move from the ECB, that the hawks are kind of have influence, or the hawks did influence that decision, rather than the ECB continuing to stick to their path of ending their of reducing their investments until the end of 2024 to the second half of 2024. So that these little comments here and there can provide some bullish sentiment to the euro, which it did last time around, or it helped to the last time round. But there were also the comments that did come through from the ECB members later on that has influenced where markets expect the rate to be, to a degree. So ECB meeting minutes then, January the 18th. So they said the market repricing could derail disinflation process. A concern was expressed. They said that concern was expressed that a sharp deflation. Concern was expressed that the sharp market repricing threatened to loosen financial conditions excessively, which could derail the disinflationary process. So if markets are expecting the central bank to cut rates sooner rather than later, you cut rates sooner than you should do, and then you have the very high likelihood of inflation then picking up again because interest rates have been cut too early. So then you get a seesaw effect with inflation. Or you could then add even more inflation than what you'd want in the first place. So this is something that the ECB members had mentioned during the ECB meeting minutes, that the market pricing is a bit off and that the ECB shouldn't be influenced by it with the pricing in of the ECB rate decision. They also said that convincing evidence of a sustained turnaround in wages had yet to emerge and that this was necessary. Members are more confident in achieving the 2% inflation target in 2025. So ECB member views then. So on December 14th, you had ECB's President Lagarde, who pushed back against market expectations for it to cut rates as early as March. So this is at the last meeting. And she said that we should absolutely not lower our guard against inflation pressures. So again, the focus, not only does it still remain on the headline consumer price data, but also the wage prices and the labor costs that the Eurozone area faces as well. ECB's Nagel on the 17th said that we should wait for incoming data before deciding on rates. Villeroy said that it's premature to say when the ECB will reduce rates this year. Panetta says monetary conditions should adapt, and we are waiting data to first confirm disinflation outlook. And then also more from Lagarde as well on January 17th. She said that it's likely the ECB will cut rates by the summer. So you had markets that were, you still have markets, or some majority of the markets that are looking at a rate cut by the end of, or towards the tail end of April, or in April. Whereas central bankers are looking at around June for the first rate cut to occur. So there is that, it's not a huge gap, but there is still that gap between the ECB, the central bank, and what the markets are expecting. So with that, that's the reason why they said that the market repricing that has been going on could hinder the ECB's efforts in regards to when they should cut rates. But it's only natural for the markets to speculate and reprice their expectations for the ECB. So it's a difficult thing for the ECB to tell the markets to stop trading. But all they can do is just warn them that it could have a material effect, not only on the ECB's monetary policy, but also the economy from the effects of the ECB's monetary policy. And the ECB's Simkus said that interest rate cuts may begin around the summer. So those are the only two so far that we've, Lagarde and Simkus, that have mentioned the summer. Hence, you have economists picking up on the thought that the ECB could start in June with the ECB interest rate cut rather than around April instead. So looking at this piece from ING, it's very useful for what they present here are the different scenarios of what the ECB could say, and then how the euro and the 10-year bond could be affected. So you can see here the current stance is inflation is expected to decline gradually and PEP reinvestments to slow in the second half before stopping at the end of 2024. Okay, so you have the dovish scenario: medium-term inflation may return to target earlier than previously thought. They also more or less repeat what they've said before in being data dependent with their rate decisions, their growth outlook as well, evidence of more sustained slowdown in economic outlook. Then on the flip side, at the hawkish or the very hawkish side, the ING presents a scenario where they say that the recent bounce in CPI signals heightened upside risk for inflation outlook. Remember, the CPI went from 2.4% to 2.9%. Adding, although there would be no hike expected, there will still be data dependent, but fiercely pushing back against rate cut bets with their expectations. In this scenario, you'd probably get the ECB saying that rate cut bets are unfounded or that they're not warranted yet, that the markets are being too aggressive or speculate. There's too much speculation that's not warranted or isn't correct, which would offset those traders who are looking to short the euro in anticipation or to speculate on the euro declining off of the expected decline in interest rates later on in the first half of this year. So what would happen if you do give the ECB that's very hawkish and aggressive in its pushback against interest rate speculation, then that would provide a bullish, or could provide a very bullish reaction for the euro in general, that the ECB isn't done with their high rate in environment, that they're not willing to pivot anytime soon in the first half, but are pushing it back to the second half of the year instead. So if they do give any confirmation as to when specifically, which month in the second half of the year that they would want to start cutting rates, that could then derail some of the momentum that those traders have had of betting that the ECB would cut rates in the first half of the year rather than the second half. So that's one risk to be aware of what the sentiment is like at the moment with the ECB compared to the markets at the moment, and that could provide some extra risk as well. Then finally, the last bit here. So they, in their hawkish scenario, a balance sheet normalization could still be sped up if required. So remember, if they're slowing their PEP reinvestment in the second half before stopping in the end of 2024, if they want to do that quicker, that would again, remember the PEP investments that the ECB has made has been to supply liquidity and support to the economy. So the sooner you take off that support, or the tricycle wheels, or the support wheels from the bike, the much sooner that the economy then has to adapt to a less supportive environment, and then that could cause more trouble for the economy in the future if the economy isn't ready for its support wheels to be taken off. Instead of taking one off, take both of them off, and then you let the kid go. Let the kid ride the bike. Okay, And then carrying on then, so bets and expectations and sentiments. So ING, they said they're trying to convince markets that pricing rate cuts is wrong, requires offering guidance. Something that the ECB may have little interest in doing at this stage. They say that we are indeed in a phase of data dependency, except Lagarde, and they expect Lagarde to reiterate it, and they don't expect this meeting to be a turning point for the Eurozone, for Eurozone rates or for the Euro. Barclays say that wages will remain elevated for some time, given the lagging nature of the European wage setting process, and those contracts that have not yet renegotiated since inflation shock could settle at high rates, while those that have already renegotiated before will start setting at low rates as inflation has fallen. JP Morgan say that analysts at the firm are wary of trending core inflation, saying its recent slowing may be the result of dissipating or of transitory factors and making the trend difficult to discern. They expect a total of 100 basis points of cuts, having previously expected 75 basis points of cuts for this year. And then the French and German PMIs yesterday that we had, which caused the euro to see a weakening. From the French PMI report, it noted that most probably the ECB won't start cutting rates in the next few months amid surging wages. And according to anecdotal evidence, input prices rose due to higher wages, confirming the concerns that ECB members have over cutting interest rates early. So again, wages is going to be quite key to focus in this ECB rate decision, because it's keeping ECB members off of wanting to cut interest rates soon as what markets expect them, markets expect them to do. Also, if you like the video so far, don't forget to give the video a like, share the video, subscribe to the channel, get the word out there, share it. You should be able to share the YouTube link. And as said, yeah, if you do like it, don't forget to give it a thumbs up as well. All right, and then in Germany, more or less the same. They've noted that the higher wage or labor costs is having an impact, but there is a need for it because employers have a reluctance to trim jobs in the service sector, resulting in a relatively stable level of employment. At December 14th, post ECB rate decision, ECB rate cut bets pair 154 base points of rate cuts from 156 before the decision. 16th, traders no longer fully priced in a first ECB rate 25 base point rate cut in April. January 18th, economists see larger ECB rate cuts more likely than smaller. And you had a Euribor options play or bet that was made. The ECB is to lower rates to 2.5 by July. So that's a lot of easing to be done in a short amount of time by the ECB. But it's something that's out there. That one bet was made, by the way, on an options contract for that. Okay, so this is the last rate decision that we had. You did have the Bank of England earlier on in the day, but this is about 10 seconds before that release there. If we kind of skip, oh no, we don't need to skip. We're good. So the data comes out, rate comes out as expected. You see the initial, you see that initial move from the index on the DAX. See some downside movement there. Don't really see a lot of movement from the euro dollar off the back of that data, or really off of the other currency pairs. So remember, what we're looking for is if the ECB, with the rate decisions, in order to get a much stronger market reaction compared to what we'd seen last time here, not only are we focusing on the interest rate decision itself, but also what the statement says. And the statement is going to be very important because everyone is expecting the rate to remain unchanged. So again, it's the wage comments that are going to be quite key. And also, how hard does the ECB push back against rate expectations for this year? if they push back at it quite in a hard way, and they say that there isn't that there's no possibility of a rate cut in the first half of 2024, or that they push that there have been no discussions on the interest rate decision itself, then it wouldn't. So if whoops, I just got distracted by my voice there on the video. So yeah, if they decide to push out the rate further, that could then provide a bullish reaction for the euro. If they're more aggressive against that, if they say wage prices are picking up steam and are affecting inflation, or are going to have a more material effect on the eurozone, and can then make it more difficult for the ECB to make their decision on when to cut rates. Again, that could be another hawkish sign from the ECB. And then you have the inverse. If the ECB says that inflation is going down towards its 2% target, wages may be rising, but that won't derail the ECB's expectation for inflation to reach the 2% goal by 2020 in 2025. And they kind of stick with their guns. And if they do stick with their guns, or actually no, the very dovish point would be if they say that they would be open to interest rates cuts this in the first half, rather than talking about the summer. So it's quite difficult with ECB because they don't really like to transmit the transmission of their monetary policy, and their communication isn't very clear. So it can make it a bit more difficult to trade the ECB rate decision. And then it's not saying there's any harder than another ECB rate decision, rate decision, but the ECB, as such, like with the Bank of England, isn't very clear in what they're looking to do, because you have these varying opinions that are not really, sometimes they're not on the same trajectory or the same line. Okay, we have Fed members that are similar in that way, but you don't really find that often, where there are very varying differences in opinions with monetary policy. Everyone's more or less, you have the deviations here and there, but then other than that, you don't really get too much of a difference. Yeah, and there's a little trade that was done there earlier on. Okay, so key things. How hawkish or dovish is the ECB? If they're more hawkish with their commentary, then you'd expect a bullish reaction from the euro. If they're more dovish with the commentary, you'd expect a more bearish reaction from the euro instead. And hopefully you did find that the information, that base case scenario, useful to have a little read of from ING as well. Okay, so that's the prep there. Let's have a look at the deviations and ranges and bring that up for the ECB. Now, this rate decision, as you've seen in the video, you didn't really get a lot of a market reaction here. So if we go, there we go, December 14th, the initial market reaction on the currencies wasn't that great. So on the euro dollar, it's seen about 20 pips towards the upside after about 10 minutes of trading. Sorry guys, apologies, give me a second. Okay, we're back up. All right. So here we go. So as I was saying, looking at the where was the biggest market reaction in the currency space? So on the euro yen is where we had seen the biggest market reaction. Now it kind of overall the euro yen has seen the biggest market reaction compared to all the other currencies historically, barring maybe the the October 26th meeting where the euro dollar inched it out. But here, the market reaction, or the initial market reaction, which is represented in this first figure here, going to the wick of the candle, again, wasn't there. There was a reaction there. It wasn't a huge reaction as we're used to in the past, when towards the beginning of the hiking cycle or just before it. And then the reaction 10 minutes after the release had occurred, represented in the black brackets going to the end of the candle, did see some further movement towards the upside though. So it did take quite a while. It wasn't an instant thing that had occurred. And then 30 minutes after the release had occurred, it had moved up by 40. It was up by 40.5 pips. So again, the blue bracket represents a move 30 minutes after the release. Black bracket represents a move 10 minutes after the release. The first figure shows you the initial move going to the wick of the first candle. Okay, so you can see, so I said euro yen had seen the biggest market reaction last time round. Then if we're looking at the stock indexes, you see here that on the stocks 50 there was the stronger initial market reaction, but from the DAX, even though the initial little pop up was weaker than the stocks 50, on the same candle, okay, it then went down by 33 ticks. Okay, rates come out. Okay. So it remains unchanged, and the markets haven't reacted. Whoops. Okay, I want to go quiet a little bit. Let's see what else we got here. If we got anything interesting from the ECB, looks to be quite muted. So just looking at it, there isn't anything new from the ECB or anything that's surprising. Similar to the Bank of Canada, there wasn't anything new. Although the Bank of Canada did have a stronger initial market reaction from the Canadian dollar, but nothing here from the ECB that's new. So in this case, no trade. And also looking at the market reaction and also looking at TICKSTRIKE, there isn't that much volatility from it. So we're not going to trade this. I'm going to leave it alone. Stay away from it. There was nothing obvious that I'd seen during that time that was quiet enough to make me go yay or okay. All right, so ladies and gents, thank you very much for joining me live on MacroAce on the live stream here. Don't forget, on FinancialJuice, we have a New Year 92 offer to be able to give you a discount on FinancialJuice. So if you haven't come across what FinancialJuice is all about, FinancialJuice provides you live voice and text for in real time, keeping you up to date with what's going on within the markets, and also what's going on not only in the markets but any global news, any statements from central bank members, if there's any change in sentiment as well. That's all there in one place. That's all there in one place for you to have a look at as well. That's the link there to sign up to FinancialJuice. So let me kind of go through the setup then on what FinancialJuice, the site, is all about and where to look for certain features. So here you have the live stream button here where the live voice plays. Here, if you can see my slider. Okay, on the left hand side here you have the economic calendar of the different economic data points, economic events that are coming up, earnings as well from the US that are here as well in the calendar. In the center you have the text headlines that have come through, again all live and in real time to keep you up to date with what's going on within the markets, so you're not out of touch or out of ear of what's going on, to keep an eye on sentiment or if there's any major economic event that has happened. So if you're not really convinced by news trading, or if you're kind of unsure of whether listening to a live voice and text service is something that you'd want to use, well, here we have our market moving little tag at the top here, shows you how not only do the economic data points have an effect on the markets, but also what central bankers might say as well. So if we kind of skip back, see how the Bank of Japan there earlier on. You had the earnings from Goldman Sachs, that data that came through. But yeah, here you can have a look at all the different things. Again, we have the ACC as another example of news that had an impact on the markets as well. There are a lot of different things that come through from the news that has an impact on what the markets would do. But yeah, so that's all there in one place. Now, I said that if you're not ready to go for the pro version of FinancialJuice, even with the New Year 92 discount code or the promo code, which is there. Okay, that's the promo code right there. Okay, so the New Year 92 is the promo code to get 92% off of FJ when you enter that in before you make your payment with your promo code. If that's still something that you're not sure about, then you can still use the light version of FinancialJuice. Or the light version of FinancialJuice, there is a delay to the live voice and text feed. You also have a delay to the economic calendar as well. you have adverts that play, advert banners that are on there as well. So, but if it's the first time you've ever come across a live voice and text service, have a little play with the light version first, okay, before you pay for it. I'd rather you understand how a live voice and text service can be used or utilized before you just jump into the deep end and say, oh, maybe this isn't for me, but I've already paid. So have a little play first with it. And that's what the live version offers you. It gives you the ability to have a little play first and see if it makes sense for you. If it doesn't, it doesn't, and that's fine. If it does, then you can, and then on the top left-hand corner of the feed or on the site where I'm clicking the button here, next to that little slider button, there is where you can see the FinancialJuice Pro logo. There will be a button that says Go Pro, and then go through that there, select your subscription, enter in the New Year 92 discount code for your purchase, and then once you've done that, log out and then log back in of FinancialJuice, and then you get the Pro version. If you want to pay for the Pro version straight away, first make sure you have an account on FinancialJuice with your login details and that you've verified your email before you make any sort of decision, before you make any sort of payment. Once you've verified your email, then go ahead and select the subscription that you want to make. And then log out and log back in, you should see the beautiful site. Otherwise, if you don't do that, then that could cause issues with setting up your account. So get your login details first for the site once you've make sure you've signed up, and then do whatever you want to do, whether you want to pay for it or whether you want to stick with the live version. James, I did get your email. I did see it. I haven't had time to respond to it. I'll make sure I respond to it today. But yes, so that is the offer there. As said, New Year 92 offer for a discount of 92% off FJ Pro, FinancialJuice Pro for the service. The link and the code has been provided there in the chat for you to use with the promo code there. Also with TICKSTRIKE, let's go back to it. So with the markets, the DAX seeing some movement towards, or continued moves, and seeing movement towards the upside. FGBL, where we got the buns here, seeing continued momentum. Yeah, well, let's close that. Let's look at the okay. Cool. So they're having a better run than they are on the euro. Let's look at yeah, nothing. Not too dissimilar from the whip soaring from the euro dollar. Okay, so TICKSTRIKE. Let's go through what TICKSTRIKE is all about. So if you're not familiar with what TICKSTRIKE is, it allows you to listen in to the buying and selling momentum of the markets. Okay, or another way to put it, it tells you how strong the buying or selling momentum is within the markets. So here, so how does it do that? So it gives you a visual and audio alert through this ticker box here that I'm showing you right here. I'm kind of waving around. And what this ticker box represents, it has varying levels of sensitivity. So level 1 is the most sensitive to market reactions. So when there's a little bit of buying and selling momentum that occurs, TICKSTRIKE will then pop off. If you drag that all the way to level 15, 15 is the least sensitive to market reactions. Okay, so when there's a big amount of buying or selling momentum that occurs, only then will TICKSTRIKE give you an alert. And yes, we do have the quarterly data from the US, prelim data for the US that is coming out in about a minute and a half's time, from what we can see here. so I said, just getting that set up there. Okay. Yeah. So as I was saying, so TICKSTRIKE, if you're looking to, again, if you're, when you're trading the market, so tool made for day traders, if you're looking at how strong the buying or selling momentum is within the markets, then you can use a TICKSTRIKE to be able to help to be able to see how strong the buying or selling momentum is. And as said, you get a visual and audio alert to that, and you can chop between whether you get a visual or audio, or no no audio alert to it if you want. So there you can have a look at TICKSTRIKE here. If you wanted to, if you don't want to pay for TICKSTRIKE, if you're not ready yet, if you're not comfortable with doing that, then what you can do is there's TICKSTRIKE that's on the site there, which is the restricted version. Okay, you don't get to chop around and play with it. You can't look at any other areas, which would be, let me keep that there. You can't look at any other areas of assets. So you're restricted to the euro, dollar, Bitcoin, and oil. GDP coming out worse than GDP data coming out at 3.33%, higher than forecasted. Okay. All right. Durable goods worse than expected at 0%. Core durable goods higher than expected at 0.6%. So did see that initial weakening from the NQ off the back of stronger than expected GDP data. Markets were expecting 2%, they got 3.3% instead. Let's have a look at JPY. Okay, dollar did see strength there. Back of the data. Jobless claims at 214k, lower than higher than forecast. GDP price index of 1.5%, lower than forecast. Lower than forecast is 2.2. What else have we got here? PCE prices advance of 1.7%. GDP deflator advance at 1.5. Yeah. Okay. So a little quick whips or reaction over the back of that data there for the for GDP. All right. Okay. As said, so that concludes MacroAce for the day and also for the week as well. Did take, but yes. So what I'll do. So for next week we have the Fed interest rate decision that we have next week. Of course, this week was the blackout period that we had. But yeah, and also we were expecting the Bank of England as well, but I'll double check that. So if you do sign up, if you want to get access to the ranges and deviations Google Sheet, what you can do is subscribe to the MacroAce mailing list, and I'll provide the week ahead of what to expect in the different sessions, US, Europe, and Asia. It's a short summary. It's supposed to act as a refresher. It's not very detailed. But there's also the link to the ranges and deviations sheet that is provided there in that place, okay, which is completely free to have a look at. All right, and then as said, also on top of that, you get the link to the upcoming live streams as well. Okay, so that email will be sent out on Monday. So if you do sign up today, you'll get that email Monday with the link to the ranges and deviations Google Sheet. Okay, all right, ladies and gents, thank you very much for joining me live. Have a great trading session, a great day, and a great weekend as well. I'll see you guys next week. Okay, bye.